The one thing I want to call out in this, and trying to give people some hope in this is that, they're trying to force layoffs. That's something that they're trying to force, right? And it's happening in tech now. It's going to happen in every industry before that they're done. Your job over this recession should be two things. Hey, welcome back to the Wealthy Idiot Show. I got DC back here again. If you notice, between last episode and this episode, we are wearing exactly the same things. We are also drinking the exact same things because we recorded on the same evening. So if this second episode, I'm not going to call it a part 2, but it's a continuation. We want to cover some more topics. If we're slightly more drunk than the first episode, I apologize. But I also don't apologize because maybe it makes good content. I don't know. You guys let me know down below. Yeah. Comment down below if you like, tipsy AJ and DC or sober AJ and DC. And we'll find out.
Yeah, absolutely.
All right. So how's it going, man?
We don't start showing our feet, I think we'll be good.
Yeah, man. No one's paying for our feet. I'm going to tell you right now.
No.
Nobody.
Yeah, I'm doing good. I think we've got an interesting topic in store. I think you're going to talk about credit card debt, aren't you?
Well, you had an article about it, and you sent it to me, and I want to kind of show it alongside with what just happened at the Federal Reserve. Do you have the article, or no?
So
I can bring it up.
I do not have the article up. I have some talking points, but I'm going to let you get started. Just in the article, disclaimer: this is complex, so it goes into a lot of metrics regarding credit card debt. But there's I hate saying read the headline and you'll get the main story, but in this case, we really want you to read the headline. So we're going to talk about that a little bit.
All right. I'm going to try and fit this in properly. There we go. Can you all see that?
Yeah.
Okay. Yeah, this is a complex topic. So I'm going to kind of go through a little bit of the stuff on the article, and we can kind of highlight some of the important parts. But I'll give a quick summary so that we all can understand what's going on here. So I was just watching our last episode, not the one we just did. No, not the one we just did last week, but like the one we did in December. And I made the statement that the Federal Reserve just increased interest rates, and they made the statement that they need to see economic pain before they can start leveling this interest rate increases off or decreasing interest rates overall. Right? Yep. And that's a little bit scary. Like, they want to actually see the unemployment numbers go down. Like, they want to actually see, like damage caused to the average person before they can change this. And the reason is in an inflationary cycle, when the government prints off bucket tons of money and floods the market and everything starts to just increase, right? So imagine you're just pouring in buckets, into a tub. At some point, you're going to hit this overflow point, right? And it makes it feel like everybody's wealthy in the moment until you hit what's called a price-wage spiral. So the price-wage spiral is when prices go up, so wages go up. So prices go up, so wages go up. And if that starts going, it hits a velocity that is way too fast. And that's where you end up with situations like Venezuela, where you have to take a suitcase full of cash to go buy bread. That's what occurs. So what the Fed is trying to do is they're trying to stop this inflationary cycle. And in order to do that, they actually have to see the unemployment numbers get hit, because they need to see that the demand for employees is going down in order to prevent this price-wage spiral from occurring, right? And they just announced last week new increases in the interest rates. So they did it in December. They just did it again in January, like the end of January. 25 points, which is 0.25, which is 1/4 of an interest rate, but it's still tremendous jump. And they promise to keep doing this until they start seeing the damage. Well, we think the damage is actually going to come pretty soon, and we think that it's going to smack us in the face. And the reason we think that is this article here. So coming through the article, the very first point here, the total amount of credit card debt hit a all-time high. And if you look at this chart, like, holy smokes. I don't even have to zoom in on the chart and explain what's happening here. Like, look at that. Like, this is crazy. This means that people are handling inflation by taking out, like, using their credit card,
Isn't that a credit card compared to savings chart? Isn't that what that is?
Yeah, it says
Yeah,
that there. Let's see. It's kind of blurry. There we go.
Yeah,
Right. So savings.
outrageous.
We all got
And
locked in our homes. We couldn't
when did that
spend
cross?
anything. June of 2021.
Okay, so recently.
Yeah, people were. Yeah, so it's gonna hit a year. What? Maybe we're 8 months ago. Is that June? Yeah, about 8 months ago.
Something like that. Yep.
Yeah. And then this is our current credit card debt, and this is our current savings. It's just normal consumers, right? And so we depleted that. We had all-time saving highs going on here during the pandemic, and then we switched. And right here between June and December is when the inflation really started to take off, and it's leveling out. But people's spending isn't leveling out. Like they're depleting their savings and they're spending on credit cards like crazy. And I understand that you have to feed your families, you have to put gas in the tank, you have to figure this stuff out. And as it also turns out, and I don't know if this article points this out. No, it's just more rate showing credit card over multiple years.
Yep.
Loans, discover charge-off rates. Okay, so yeah, this article doesn't point it out, but the amount of money being spent on discretionary items has dropped significantly. People are spending money on needs, and even spending money on needs, we're seeing this credit card usage going way up. So at some point, that's not sustainable. People can't keep doing that. And when that hits that point, what happens? Right? If your job can't even meet your basic needs, what do you do? Right? Everything's too expensive.
Yeah, and Discover, one of their analysts, I think it was Discover, they brought up a good point on the data. So you see where that chart kind of turned in June of 21.
My bad.
Per Discover, they don't usually see defaults until 18 months post the debt being created. So if we just started the turn in June, that's just hitting the 18-month mark. So you could argue that we could have 18 months of increased defaults, that would put us into 24. That's a long time. So yeah, I think this is problematic. I don't think it's good. I think if you look back to the 2020 timeframe and into 2021, those savings rates were artificial. I think they were built by stimulus checks. What did we have? 2-3 rounds of stimulus checks?
Well, yeah, but not only that, because the stimulus checks hadn't come in yet here. Right? This is right when COVID
So
took
that's
off,
just when
right
people
here.
started saving because they weren't leaving their house. Yep.
Exactly. So, people could save. This tells me, and this is a totally different topic, but this tells me you're all capable of saving. I know you're all capable of saving. So when people are like, life's too expensive and, I can't save any extra money. We know that that's not true. The pandemic just proved it.
2020 says that's a lie.
Yeah. It's just that you have to be forcibly locked in your home, apparently, to get savings. Then you need to, come up with some better solutions on how to manage your money. That's a different episode.
Are you saying we should lock everyone in their home?
I'm saying that, you should find a way to lock yourself in your home, if that's what it takes. I don't know.
I'm just throwing it out. Yeah, so this is crazy. And so some of this may not have a lot of context to people. So I wanted to go over some little facts with this because I think, like I said, this is a confusing article. I read it a couple times. I had a hard time with it. It does have a lot of facts and figures that aren't commonplace. Oh, you wanted that sound? That's cute. Okay. Nonetheless.
Don't worry about me.
So, total credit card debt in the United States. So it just reached $866 billion.
Jeez,
So that,
man.
that's the total number. So that's a really big number. I wouldn't mind having 866 billion, but that's beside the point. So this is 20% over 2021 levels. So just in the last year, we've increased 20%. So not a good trend. And 2023 is shaping up to not be a good start. So I think we could see that continue. Right now, the average interest rate on those credit cards is 19%. So to put, yeah. So I did some of my own research on this. I checked all 4 of my credit cards, and my highest interest rate is 12. So I don't have anything within 7 points of the average. But even worse, TransUnion is predicting that the average rate is going to be 20.5% soon. Yes.
This is the opposite of wealth building right here.
That is the opposite of wealth building. So if you're carrying a 20.5% rate on a $10,000 balance, I mean, you're paying $2,050 a year. $2,050 a year in interest. I think that's right. Math was never my strong point.
Yeah,
But anyways,
no, you're right.
that's insane. I mean, you're just handing the bank $2,000, and that's only on 10 grand. So if you think about people that have $100,000 in credit card debt, which shockingly is a lot more people than you and I think.
What's the average credit card debt?
I don't know that I got the average. I do have one more little not fun fact, which is delinquencies are up 54% from last year. And that is the highest since 2014. So
the average credit card balance is $5,500.
That's not good.
Right? So then, we take the calculator out real quick. You said 20.5?
Yeah,
is going to be the average rate, right? So 5589 times 0.2, what is that, 50? Yeah, 205. 1,145. The average American, the average American with a credit card balance, right? Because not everyone has a credit card balance. All those Dave Ramsey watchers out there, they're on the winning side right now. Yep. The average American is going to spend $1,145 on interest alone next year. Yep. And that's 2022 numbers right there, because we don't even know what it is now. And on that chart, if you're a mathematician, you automatically know there is nothing on that chart that shows a slowdown. That's a line that's going straight, and theoretically that's going to continue until something else occurs. I don't know how that's going to look, but man.
And can we talk about the mechanics of credit cards? Because I don't think people understand this. I think this is a gap. So, so when you pay your mortgage interest calculates in 30-day chunks. So basically your mortgage is calculated in a year, and you divide the interest rate by 12, and you have, you can kind of figure out the interest for 12 months. In the case of credit cards, that interest is daily. So once you have a statement balance that has not been cleared, meaning paid off, you're going to have daily interest. So if your interest rate is 21%, you take 21 divided by 365, and your daily interest rate is whatever that number is. I'm not going to do the math for this, but you get the point. So the flip side of that is that if you have not hit your statement date and that point where the payment is due, you have not accrued interest. So I'll give you an example. Let's say my statement from the previous period closes today on the 3rd of February. So my statement is January 4th to February 3rd. Okay? And then tomorrow morning, I go and spend 10 grand on my credit card. I will not owe interest on that transaction for 60 days. Because they're not going to tell me my payment's due. They're not going to do the statement closeout for 30 days. And then they're going to tell me, hey, your payment is due 30 days from now. So I'm going to get a 60-day lead with zero interest. I'm going to get interest-free loan for 60 days. So that's great. But if you don't pay that 10 grand in the 60 days, then you're going to start accruing daily interest. And I'm going to do the number just because now I'm curious.
Daily.
So let's use 20.5% divided by 365. That's 0.056% per day. So times 10,000, and that's the wrong number. Hold on a second. 0.205 divided by 365. So it's 0.0005. Sorry, decibels in the wrong place. Times 10,000. So once you miss that payment and you haven't cleared that debt, or let's say you make the minimum payment, which is probably like $40, not a big deal. You're going to accrue $5.61 in interest a day. So you're going to accrue a Starbucks coffee per day in interest. That's nuts.
That is crazy.
Yeah. So when you put it like that, credit cards are a little more understandable. Now you got to remember, when people start accruing balances on 5-6 cards and they all exceed 5 to 10 grand, you can see where this starts to get unbearable. I mean, you have balances, you can't keep track of statement dates. You have one card at 26% and one at 18%, and it hurts. So I think when people understand a little bit more about the mechanics and how these things work, they may be more apt to, I don't know, avoid them.
So correct me if I'm wrong, because it's been a long time since I've had a balance on my credit card. And I had a balance on my credit card in like 2016 on accident, and it cost me like $30 or something. I mean, that was a total accident. I just missed a month. I was busy. But so correct me if I'm wrong, but isn't the minimum payment on a credit card less than the actual interest accrued? Isn't it possible to increase your balance by just paying the minimum payment?
I think so. I think if you have a really bad interest rate, you could technically be gaining balance every month without ever spending more money, which is
then that like $5 could be like $5 and a penny, and then $5 and 5 pennies, and then before like and you're actually paying it, like you're paying your interest, but like and your minimum payments, but then each month that's just gonna go up slowly over time.
And credit card. Hold on, credit card minimum payment percentage. Let me see what the actual. There's an industry standard. So typically 2% of your statement balance is your minimum payment. So we could do some math and figure this out, but I could tell you, based on interest rates, you're not far off. You really gotta watch.
Well, yeah. Let's see. Minimum is 200, so times 12, that's 2,400. So if your interest rate is above 24%, you're in trouble.
Yeah, so at 20.5%, you would pay, you'd pay $2,050 in interest. And what did you say the yearly payments would be?
2,400.
Yeah, so you would barely covering. So you would pay off $350 of your balance in 1 year out of 10,000. That's horrible.
You're gonna and you're gonna fill that again. Like, let's not lie to ourselves. Like, especially right now with how everything costs so much more money, you're gonna be like, I need gas, and you're gonna, you're gonna add more.
And dude, this makes me almost as mad as the whole IRS thing, because this is something that no one is taught. So I guarantee you, the people that watch this video are gonna listen to this and say, wait a minute. First of all, you don't pay interest on a credit card for 60 days or possibly 60 days, usually at least 30, but nonetheless. Holy cow, I didn't know that. And then they also didn't know that they could be getting charged $5.61 a day. I mean, no one tells you these things. Oh, I mean, we do, but, most people don't.
Yeah.
It's infuriating. It makes me mad. This should be taught in every school in the country. Yeah.
So I think moral of the story is we got the Federal Reserve is going to keep raising rates until some dramatic stuff starts happening in the economy. You got a bunch of people who are upside down with credit cards right now, to the point where it's possible that you could be increasing your credit card balance just by paying the minimums. And then our savings rate is nothing. We just blew through our savings right as soon as the government opened up. Then we're like, hey, you can go back to life. Everybody blew through their savings like it was nobody's business.
Yep.
And inflation is starting to balance out, but it's not like people don't understand this too. Think like prices are not going to go back down. We care about the inflation rate. We're not concerned with the current cost of items, right? So the Federal Reserve wants to see a 2% inflation rate, meaning that year over year they want to see inflation at about 2%. Yep. The prices have already increased. They want to see 2% against where they're at today. They're not looking to see the prices go down and then add 2% on top of that. So prices are going to stay, and they're going to stay forever, and they're going to increase next year. Hopefully at 2% if things are good. But we don't know that, So we're going to keep adding pressures until people start losing their jobs, not just in tech, because, we've pointed that out a few times. Tech is seeing layoffs like crazy, but mostly because they just added employees over the pandemic because they were seeing tons of new demand for their products over the pandemic. So they're laying off basically most of those people, but the Federal Reserve is not going to stop until we're seeing layoffs in every sector, and then they're going to relax, and they're hoping things are going to go, smoothly. So, with that in mind, what's the strategy? What do people do? Let's not leave it on that negative note.
Yeah, so I'll talk about a couple things. So if you have, I'm going to go with behavior first. So I think if you have behavior problems, and I'm not talking like you pee off of balconies in hotels, like things like that. I'm talking like spending behavior.
Those were my Marine Corps days, dog.
Yeah, absolutely. But I'm talking
over
more
that.
so financially. I haven't done it in a long time, or ever.
I mean,
never done
yeah,
it.
right? We've never done that. What?
So, I mean, realistically, if you know you have a behavior problem with money, I think the best thing to do is recognize that. So the first thing is, hey, I know I shouldn't have 12 credit cards. That's a good self-realization. You understand that, and you can immediately prevent yourself from the 12 credit card problem. Yeah. With that being the case, I think everyone should have a credit card. So I think in the case of a person that's irresponsible, maybe you have one and you keep your limit at about $1,000, and you make sure that you pay it off every month like clockwork. And what you'll do is you'll kind of mentally prepare yourself to treat that as a normal bill. So I use my credit card for all bills I am able to pay with a credit card. And I've just gotten to the point where I'm used to my whole paycheck going to pay off the credit card because the credit card has paid the bills. So it's just a cycle. I don't pay bills with my paycheck. I pay my credit card with my paycheck, and my credit card pays my bills, and the cycle continues. Now, are there months where I'm like, hey, my paycheck doesn't pay off my credit card in full? Absolutely. Happens to the best of us. Full disclaimer. The best thing is to know that if you've paid off your statement balance, you will not pay interest. So I actually tried to research this before this episode. I went back through all my credit card statements on my longest card, and I can't find when the last time I paid interest was. So that's cool. I was happy to see that. I mean, it was years ago, clearly. But like you said, you got hit with $30 one time. Like, eventually you're all going to, accidentally catch an interest charge. But I think the first step is you identify.
Like on the flip side, I just cashed out a bunch of points, and I cashed out like $1,500 worth of points that I've accrued just in the last quarter, right? Like just since October till now. So I've well made up for my $30 mistake.
And credit card rewards are not taxable. So
Amen.
That's huge. Yep.
There's a YouTuber by the name of Caleb Hammer. And I like him. What he does is he brings people into his studio, and then he goes over their finances, and then he just berates them to their face. And there's nothing more delicious than like watching someone just get smacked down. Like, and these poor people, like, I don't know why they volunteer for this, but one of the things he says, and I love this statement, he's like, "You're not a credit card person."
And then I would never use it. Never use it again. You're not a credit card person. I would, in fact, close it, but I don't think you're going to do that.
He's like, there are credit card people. You're not a credit card person. And, in light of what you just said, which is like, some people are just not credit card people. And if you're not a credit card person, that's cool. And I was not a credit card person in my 20s. I'm a credit card person now. So it's not like that's permanent, So if you're not a credit card person, that's okay. Get rid of the credit cards. It's okay, right?
Yep.
We don't all have to be the anti-Dave Ramsey crowd. Some of us need to actually follow Dave Ramsey for a while, and then we could switch over to being more smart about it.
Yeah, absolutely. And like I said, behavior is the first step. I think the second step is you get a consumer-friendly credit card. So I'm going to call out the Discover It card. That's a really good one. Super consumer-friendly. A lot of college students have it. Keeps a low balance. Usually interest rate is, not horrible. It's a good learning credit card. It has 2% cash back. It has a 5% bonus category. So in some months you can get like a 5% bonus on gas. Who wouldn't want that? Up to $75. So I think, there's good perks on different credit cards. And then I think lastly, and I will pound this point home, if you have a good budget, it will fall in line. So if you expect to say my credit card is my budget, that is a bad plan. That's not a budget. You should have a budget, and then your credit card should just be the medium in which you're paying those bills. It shouldn't make a quantifiable difference. So if it is, then you have a budget problem, and the credit card is just kind of helping you. So that's the big piece there. I think if you could do those three things.
This is the for the budgeting thing. This is the thing that saved me. For people who have struggled with budgeting, because I've struggled with budgeting before. What I have to do is I recognize that there's a certain percentage that I'm just not good at keeping within the budget, and it could be 5 or 10%. Let's say 10% on the high side. If my budget says I can spend $50,000, I'm going to spend $55,000, right? And a lot of us are like that, and I think that really dissuades people from budgeting. What you do is, if you know that you have a problem that's about 10% of your budget, then you budget for $50,000. And then you try as hard as you can to fit into that. And when there's certain scenarios where you just can't, you have a little bit of overflow. And that's what we do. So like what we could spend and what we do spend aren't the same thing, right? What we could spend is way past what I have budgeted, right? And then what we budget is really conservative, and that keeps us in our lane. And then when we accidentally go out of our lane for some reason, like an emergency, whatever, we got it covered because, we have more than that.
Yep.
But it's that self-discipline, and with a combination of figuring out how this stuff works for you. You have to have the discipline, and you have to personalize it to yourself. You have to know yourself. If you're not a credit card person, if you're not a budget person, you got to figure that out.
Yeah, definitely. And, credit cards are they're a burglar. They will burglarize your retirement savings and your emergency savings and all those other things that you want to have are really hard when you're chasing a credit card bill. So that is it's a burglar. That's the best way I can call it. It's going to hurt every part of your budget. So
what I like to call like credit card debt, and I've said this on the channel before, is you're borrowing from your future self and you're paying someone else to do it, right? You're taking money from your future self. Like, let's say you had a 0% interest loan, and I'm just talking consumer spending. I'm not talking like investing, but consumer spending. You're taking out a loan, even at 0%, you're taking out a loan from your future self. Your future self has to pay that still. It's not like this is free money. You still have to pay that. And if you have an interest rate, which all of us do, like you have a great interest rate, like you have to pay somebody else to take out that loan. So you're paying Visa, MasterCard just to borrow from your future, which is crazy. Yep. Stop doing that. We got to stop that. The one thing I want to call out in this, and trying to give people some hope in this is that, they're trying to force layoffs. That's something that they're trying to force. Right? And it's happening in tech now. It's going to happen in every industry before that they're done. Your job over this recession should be two things. Keep your job, right? So like your task, to make this clear, your task in this recession is to keep your job first and foremost and invest as much as you can. And the reason is the people who keep their job when the layoffs start coming are the people who are automatically going to be ahead when the economy turns around. You're going to be the ones who get promoted when everything starts to expand, who the world is going to be your oyster at that point. The person who lost their job are going to be the ones trying to scramble to figure out what to do when the economy turns around. The second thing is, if you have your job and you're investing, the second part, investing, you're getting in when the market is down, which means that when the economy turns back around, you're going to see that growth like you've never seen before, right? The average bull market following a recession is like 25% increases over the next 4 years. You could double your money, and this is not guaranteed, right? There's no guarantees in any of this stuff, but
never.
This is just data, right? The average return after a recession like this one is going to double your money within 4 years of anything you invest. There's nothing else that does that. I mean, the 401k does that to a point, but then what else does that? Like 25% returns is nuts. And so if you can keep your job, you can get those 25% returns. When this economy flips around, the world's going to be your oyster. So this is your opportunity. Like wealth is made in a bear market, and that's now. We got to get into it now. So like I understand the data doesn't look good. Things seem hopeless, but people who are successful because they do the work now.
Yeah, you're bringing up a good point, because I sent myself a reminder earlier today to talk about this. So this is a good segue, because times are tough right now. We can acknowledge that, right? So, what are some of the things that are going to happen that could make it even worse for you? And one of those things is slimy insurance salesmen trying to get their hands on your money, right? So,
True story.
I'm gonna screen share this because it's related. It really is, and I think we got the time for it. So, look at this. This is crazy. Read that title.
Annuity sales hit record last year, eclipsing sales during 2008 financial crisis amid fear and higher rates. Yep.
Owie. So, I'm not gonna disclaim on here that, or I'm not gonna claim on here that all annuities are bad. That's not the case. SPIAs, single payment immediate annuities, I think is what it stands for, single payer, something like that. That's a decent product. MYGAs, multi-year guaranteed annuities are pretty good. But that's not what these are. The vast majority of these are like variable annuities, indexed annuities. They're things that have surrender fees. They're products that promise to return 5%, air quotes. And what happens is you
Before
do return.
fees.
Yep. So you do return 5%, but you also lose 3% to fees. So you return 2%. Well, if you want 2%, why don't you just go get a high yield savings account? And you can skip the whole annuity step. I mean, it's literally pointless. So, you add all that stuff up, and I'm thinking about, if I'm hurting, which I'm not right now. I mean, don't get me wrong, I feel the grocery pain and I feel the inflation, but I'm not hurting. If I'm hurting,
come to California.
You'll
feel the
worse
pain.
off.
Yeah.
But if you're really hurting and you wanted me to tell you the last thing you should do, this would be one of them. I mean, don't go buy an annuity. What are you hedging? I mean, First of all, right now, the companies want to sell these things because rates are terrible. So they're selling a ton of them because you're locking into a bad rate, and the insurance company loves it because they know this is going to turn around. They're not stupid. So, you're tying up a bunch of money. You think you're getting a tax break. Most people don't even need the tax break. They just don't get it. And then additionally, you think you're getting market returns. Well, sorry for you, 5% is not a market return anyways. That's super low in my opinion. So, all this stuff, you add it together, the credit cards, you add together like the audit increases, the fact that, you can hear stories out of Florida that people are getting 300% property tax increases because of constant hurricanes, and their insurance industry has some problems with fraudulent roofing claims. You've probably heard of that. So, you add all this stuff up, and, the average family of four that just bought an annuity could be up a creek without a paddle. I mean, it's bad. So, I think this stuff needs to be avoided. You really, safest place for your money in any market is stock market, real estate market, and in your bank account. I mean, that's
Real
really
estate.
or your pocket, however you want to call it. But
No, that's not a safe place. Don't.
Yeah, but I mean, what I'm saying, if you have $1,000 tucked away and you're safe, that is a good fallback, because worst comes to worst, you do have that $1,000 sitting there. But yeah, absolutely. Real estate, stock market, like, you need proven assets that are going to eventually overcome bad times. And insurance products are never that product. So, or asset. I wouldn't even say it's an asset at all. But
I agree.
We've talked about that.
So I think this comes from, I don't have any evidence to suggest this, but just my own, what I'm seeing from reading and just watching people. And what happens is, you figure out financially what the right thing to do is, right? So at some point, let's say, in your 30s, you found, the equivalent of the Wealthy Idiot show, whatever that was back in the 90s, and then you did all the right things. So you invested your money, you weathered the storms, you weathered the dot-com bubble crash, you weathered the 2008 crash, and you got here today, and you're like, I'm retiring now. And then you see your, entire portfolio start to decline, right? And that's a scary thought, because we joke about this regularly. We're like, we want all the recessions to happen while we're still working because we want to be able to buy stuff while it's on sale and keep adding more to our portfolio while it's on sale. But you don't really want that when you're retired, because once you're retired, you're not adding anything new. You're just taking the hit now. And I would not be surprised if it turned out that most of the people buying annuities are people who are getting close to retirement or are retired, and they're just moving their money over because they want the security of getting those returns, right? And I've been meaning to do this for a while, but I should do this at some point in the near future, an episode about what to do when you actually hit retirement, because what you should be doing when you hit retirement, and this is just a really low explanation, like really simple, is that on good years, you should be taking out more and putting it away. And then on bad years like now, the Fed is going to increase the interest rates. like you said, you know that the high yield savings accounts are going to produce. So the money that you're taking out that's extra, you don't spend it in good years. You put it into a high yield savings account. And so when the economy starts switching and the high yield savings account starts producing more, then you have that to withdraw from, and that continues growing, right? And then on the bad years, you have something to draw from. And then when it turns around, you start the process all over again. You can do that yourself. You don't need to pay someone to do that for you, because that's what an annuity is you're paying someone to do that process for you, and they're going to take most of your growth, right? We just talked about the 25% returns following a bear market. You're not going to get those 25% returns following this bear market. You're going to get the 5% on your fixed annuity because that's what you went out and bought. And then the company who is investing your money is not only taking fees out, they're taking out fees, they're also going to take the other 20% gains following this market. And they're not going to apologize about that. They're going to walk away and buy a yacht, and you're going to be left feeling like you won somehow because you took a fixed annuity, and that's returning, like you said, 2% or whatever, right? It's not a win.
Yep. Yeah, and to your point, we talk about this a lot, but, all this advice isn't one size fits all. So, I talk about the fact that I hate high yield savings accounts. I think I've mentioned it before.
Yeah.
I hate them today. I won't hate them when I'm 57. So,
yes.
Yeah, I just want to throw that out there. It's a perspective, and a lot of it's based on age. So I'm in my mid-30s. I'm not enthusiastic about putting money in a high-yield savings account. I'm enthusiastic about buying as many shares of VTI or VOO as I can. And over the years, that will turn into a massive pile of money.
Not financial advice.
Not financial advice. That's just my preference. You can look up your own preferences. There's a lot of
personal
publicly
preferences.
Available. Yep.
My preferences might or might not be exactly the same.
No, and that's where I say don't take my advice of, I say I hate a high yield savings account. That's just my current self saying that. I do think there's a time and a place for it, and you brought up a good point. The theory you talked about in retirement is called sequence of returns risk. So basically, it's the theory that if you catch a string of bad markets and you have to pull, let's say 5% from your portfolio a year, and the market keeps crashing, that eventually you'll be impacting your plan enough by those withdrawals and market losses that you'll not have enough money to survive. So that's the theory behind it. That's why people have come up with things like the safe withdrawal rate, and they call it 3.5%. Mm-hmm. That number is supposed to be impervious to that. However, again, you could have a 6-year span of bear markets, which would be unusual. So there's some wiggle room in that. So just keep in mind, you have to develop a plan that's robust, survivable, repeatable, all those good things.
Yeah, very true. And then you said something, and I'm just blanking on it now.
I said a lot of things. You'll have to think back.
That was a good point. Oh, yeah, about like high yield savings accounts are not so in your 30s, in your 20s, and in your 40s, right? Like our whole goal should be to get rid of cash as fast as possible. We talked about that in our episode in December, right? Like cash is trash. Get rid of cash as much as you possibly can. Like holding on to cash is losing value. But when you actually hit retirement,
$80 in my checking account.
Yeah, exactly. When you actually hit retirement and you're actually trying to figure out how to manage that, right? Putting cash into a high yield savings account is going to become a requirement. So when we say cash is trash, we mean, for the people that are in the working ages that are still investing, still trying to grow their wealth, that's when cash is trash. When we actually get to the end, don't buy an annuity. You don't need it. This is not financial advice. But that's when you start being smart. And on years where we get like a 16% return, right? The market's up 16%, right? You still only spend whatever that safe withdrawal rate is. You still only spend 4%, but you take out 8%, right? And you stick the other 4% into a high yield savings account.
Yep.
Right? And you do that every year that the market's up, so that when the market's down, then you're safe. You don't have to worry about it. And you can continue spending as if nothing occurred. And you could live your life and, kick your feet up on a beach and have some rum, because that's what all the business is about.
Absolutely. But coconut rum is better on a beach. That's neither here nor there. Yeah. But no, that's pretty much it. You hit it spot on. Again, the moral of the story is don't freak out. I think you said people have 2 tasks: keep your job and then keep saving. I mean, that's really a simple way of looking at it. Yeah, keep investing. And nowhere in that does it say buy an annuity. Actually, I would argue you should not buy any insurance product unless it's term life anyways. Not financial advice. That's just general housekeeping. So, but yeah, that's what I got on credit cards, annuities, the economy. That's pretty much where we're at right now.
Right on. Well, good episode, man. I super appreciate it. I love when you come on because this tax stuff and some of these details to a degree that I would say most people just don't. Right?
Yeah,
and
I would,
like the credit card stuff is incredible.
I would like to have some audit experience, but at the same time, I don't really want audit experience. So the day I'm on here and we're talking about our experience with audits is a bad day.
Yeah, that's the truth. And if I ever get audited, I'm recording the whole thing. I'm gonna put it all on YouTube. You guys can all watch the whole thing.
Absolutely, yeah, we should. I like that.
And my IRS agent, if you see these episodes, hint, hint, I'm going to record the whole thing. So.
Do you think you have a personal IRS agent?
Oh, 100%. He's like my guardian angel, but like the opposite. He's the devil on the shoulder, right? The opposite of my angel. He's the one who's like, oh man, that money that you got there, you don't got to report that.
Yeah, they're talking to each other. Like, no, you should
100%.
report it. Be a good citizen.
And he's got a little suit and tie, and he's got no soul, because that's all the IRA agents.
Absolutely. I gotcha.
All right, man. Well, I appreciate you coming on. We'll do this again soon. And any final words?
No. Just watch that spending and, try to keep your job. And if you lose it, find another one. So,
hustle.
Bear
Appreciate you watching. Time to hustle.
Yep.
All right. Appreciate it, man. And thank you all for stopping by. We'll see you guys next time.
Thanks, guys.